All right, where is the stock market going to go from here? Are we looking at another push to the all-time highs, or should we start getting very weary about being in our long positions and start booking some profits and be preparing ourselves for what might just be the next leg lower in the stock market? We're going to talk about all the different scenarios that I see possibly playing out here and what I think is the best way to manage your risk and give you an opportunity to profit out of this stock market that has just been one of the wildest stock markets in recent years. Now, one of the things you want to remember, and we've bounced over the last 11 days. I've been away from the stock market for a few days, so I haven't really missed much because we've been consolidating just for 6 straight days. It's just been up and down the entire time that I've been gone. But one of the things that you want to remember is that with each consecutive bounce following the next leg lower where we establish new lows to the downside, each one of those bounces tend to get less and less powerful. So the bounce that we're seeing right now isn't likely to be as powerful as the one that we saw back off of the March 14th lows. Sell-offs over time tend to get steeper and steeper, and the bounces tend to lose their momentum with each consecutive bounce until we actually put in a bottom in the market, which is at the point where all the selling has been exhausted and there's really just no more room for the market to go down. Then you get that nice bottom that you can put to work some long-term investments. So with all that being said, let's go ahead and jump right into the charts here. Within this channel, we have had a nice bounce. You can see how many times we have consistently bounced off of this lower channel band. 1, 2, 3, and then a 4th time that we've bounced. So this 4th time has been much better than the previous bounce. But over the last 6 days, we've done nothing but consolidate. This has been a very choppy price range. And when you go and look at it from like a 15-minute view, this price range is very, very tight, and we have not been able to break out of it to the upside. So with every move to the upside has been matched with a move back to the downside, and it continues to test the upper and lower ends of this price range. But it's very difficult, and I still have a little bit of long exposure with SPY in my portfolio, but it's very difficult to want to get long on this market as long as it continues to stay inside this price range. What's the incentive for getting long while it remains stuck in a price range? There isn't any. So in order to get more long, in order to add more long exposure, we need to see it break out of this range. And this range is great because you want to know something? When it does break out, it usually provides a much more dependable breakout because it has spent so much time consolidating, so that when that move ultimately happens, it's a much more dependable move had it only been like a 1 or 2 day consolidation phase. So right now, I am really interested in seeing whether or not we break out to the upside or break down to the downside. And that will determine how bullish or how bearish I get in this market going forward. But now let's go back to the daily chart here. Again, like I mentioned, we have this declining channel. They're not parallel, they're not perpendicular, and they don't have to be. But you have resistance overhead that it has not been able to break through yet. You have some solid support underneath that it continues to bounce just like I had already said. But you also have the potential for another declining trend line here in the much more shorter time frame that has held up pretty well to date, and it's getting very close to testing it yet again. So a move out of this price range could see some quick resistance being tested around this 420 area, and it may result in a sharp rejection that takes price right back down to this lower channel band. Now, another scenario I want you to consider is that we may not break out of this price range. Instead, we may break to the downside. Now, you would say, okay, we're in a downtrend. We're continuing to see lower lows and lower highs all throughout. For example, lower highs, and another lower high. These are all lower lows going all the way across this declining support level. But what if we don't make a lower low? We break to the downside and we retest these lows and put in a nice double bottom. So you would have your first bottom and then the retest of this bottom, and it holds. That would be your second bottom. And then from there, you get that explosion in price to the upside that eventually sees a retest of this much bigger declining resistance level before ultimately taking that big drop lower that takes SPY below the 380 level. You saw a little bit of that back in January where we created one low and then we created a second low, but it wasn't quite a double bottom. But if you go to the Qs, you do get that double bottom price action. It looks really nice. We bounced and then we came right back down and we tested again, and then we had that explosive move higher that tested the declining trend line. So that's going to be a big key going forward, is that if we do break down to the downside, you want to be very careful. You're getting short how price responds when we get down to this lower area here. Now you have the same consolidation in the Qs as I had just highlighted in SPY. Now what if we break out to the upside on the Qs? Then there is some similar resistance, not the same kind of resistance, but it's very close nearby in terms of similarities. This resistance level going all the way across should pose some difficulty for price to get through in the near term. So we may see a price rejection there, which could ultimately result in us retesting those lows from May. And if we can test those lows and we can hold those lows without breaking below them, then that bounce that comes thereafter should see a retest of this major declining trend line off of the all-time highs. Now, in previous videos, I have talked about the Fibonacci retracement levels. What kind of retracements have we seen so far? Well, on the Qs, we barely reached that 38.2% retracement level. Let's go ahead and look at that right now. Here, if I draw the Fibonacci retracement level, you can see it barely touches that 38.2% retracement level. It didn't get quite up to that 50% like I was hoping for. That would have created an incredible rally for the markets as a whole if it could have gone all the way up to there. On SPY, the retracement level went actually beyond the 38.2% level, but did not reach the 50% retracement level. So this bounce has been a little bit more weaker than what I was expecting. It got close, but it didn't get quite there. Now, it could still get to that point, but with this consolidation that we're seeing here, it's a real toss-up whether or not we're going to see it. And one more thing I want you guys to see here is that when we got the bounce off of oversold conditions. Now, since then, we're actually overbought now. So the selling pressures have let up a lot to where there could still be another leg down. And if we test these lows that I talked about from May, you want to see how price reacts. Does it get a sharp bounce or do we slice right through it? That's going to determine whether or not you want to close out any short positions that you might have. And for my partial SPY position that I still have, I'm going to be watching to see what happens if we break out of this consolidation pattern. If we break out a consolidation pattern, I'm going to be very much inclined to go ahead and close out that position. So I've thrown a lot out there at you guys, and I did that intentionally because it's been a couple of weeks since we last discussed this market, and I know that there's been a lot that's been going on with this sideways consolidation range. And is it going to lead us to higher prices, or are we going to go back and retest those lows from May? Take everything a step at a time. Right now we're in consolidation. I don't have a reason to get long or short until we break out of that consolidation. And then once we break out of that consolidation, I can go ahead and make my moves. If we break to the upside, I can get more bullish. If we break to the downside, I can get more bearish. And then if it's to the downside, I want to start looking at what happens when we retest those lows from May. And if we slice right through them, then I can start being more aggressive with my short positions and push it a little bit further to see how far down that market wants to drop. If it doesn't do that and we bounce, then that's where I want to go ahead and close my short positions and start looking at an opportunity to get long to play that double bottom opportunity. In the end, there's going to be winning trades and there's going to be losing trades in it, but we have to make sure that we're managing the risk, that we're putting in our stop losses, and we know where we're putting our stop losses in before we ever get into the trade. Once you start losing on the trade, that is not the time to start figuring out how to manage your losing position. You got to know that stuff ahead of time. As always, make sure to like and subscribe. I appreciate you watching this video with me. Tell me down in the comments below, what is your thoughts on this market? Are we going to retest those lows from May, or are we off to the races to the upside still and we have more room to run? We're going to get that 50% retracement on SPY, even on the Qs, and maybe even a little bit more. Maybe we hit that 61.8% retracement level. Tell me down in the comments below. Thank you guys, and God bless.